Orange tie. Broncos. Again, here we go. Everybody's got to have a hobby, and mine's been money for a long time. And hobbyists are captivated by news, and so each evening at bedtime, I could kick on Bloomberg and I could catch the Asian market open and get an idea what's going to happen the next day. And last night I kind of wish I hadn't, because the news was so big that I struggled to sleep and not think about it. But the surprise was Bank of Japan went to negative interest rates, meaning banks that leave money on deposit with the Bank of Japan have to pay the Bank of Japan to leave it there. And as in the copy nearby, the deflation phenomenon means that the cash in your wallet is worth more tomorrow than it is today. And it's worth more the day after that. So why should I spend any of that cash if the price of anything that I want to buy will be lower next week than it is this week? So quantitative easing was the effort to liquefy markets and to replace credit that broken banking systems couldn't provide. This negative interest rate business is an effort by central banks to scoot money out the door and out of your wallet and get you to spend it rather than keeping it. It's not working either. Well, I mean, it might be, but once we're trying it, we can't tell what life would be like if we didn't. Anyhow, Bank of Japan, throwing in the towel this way, says that Abenomics is a bust. It says that all of the quantitative easing to date in Japan is not getting the desired result. And the most immediate response is from the Pavlovians in the market, which are stock markets. Stock markets here, central bank is easy, and buy. And so that the stock market here, Dow is up 400 points today. Stock markets everywhere rallied. In another few days, it will occur to them that the Bank of Japan did what it did because Japan is in a whole lot of trouble. The functional effect in the rest of the markets is to devalue the yen, which gets the yen under everybody else and is going to force everybody else to follow it down. China is in a sincere effort not to devalue far or fast, but having the yen come down underneath it is going to pull it down. And the tertiary effect here involving the Federal Reserve, their credibility is at stake now. Not their credibility that they're going to do what they say that they're going to do, but whether they have good reason for saying what they think they're going to do. And it doesn't look very good. But everything else here couldn't be better news. You have mortgage rates all of a sudden down to 3 3/4. Long-term rates here are down to the lows of a year ago. There are good reasons to believe that we may test the all-time lows in the months ahead. The yield on a Japanese 10-year note is 0.1, probably soon to go negative. The yield on German bonds is not at an all-time low, but it's getting close. Those going down pull us down, pull down our rates. And in companion news that might have been ugly, the GDP slowed down. There is no inflation here. There's no wage growth here, which is not the world's greatest news, but since there's no inflation and the rest of the world is going down, there isn't so much need for the Fed to go up. And so we sit here. 1 month ago, I do not know of a human being who thought that U.S. mortgage rates would fall between 1/4 and 0.5% in the next 30 days. So there we are. Have a good weekend.